This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
So it all starts with a thesis in my mind. So again, I mentioned this already. It's like I focus on needs, not wants. Why do I do that? Because there's this thing in the world called our economy, and it moves in cycles. And if I can insulate myself from a down economy by focusing on needs, not wants, then I'm somewhat isolated, from the impacts of a down economy. And security and cash flow is important. And so, there's a lot of different considerations that we have to make. And so what I typically would tell someone is it starts with a thesis. So I'm starting out, maybe I have no experience, maybe I have limited experience, but this is my thesis on what I'm going to do. I'm going to build a portfolio of single family rental homes, and I'm going to put them in these types of neighborhoods with this type of a rent base, this type of a capital cost, or I'm going to focus on A properties, B properties, C properties. I'm going to be in opportunity zones. I'm going to be in, it's what is the profile of what I'm doing? And I need to write a very detailed thesis in order to demonstrate to the lending community.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Quick question. How'd you find this show? Maybe a tweet or an Instagram post? Well, no ads here. Just a small favor to ask. If someone introduced you to this podcast, pass it on. Share, review, tell a friend. It means the world to me. Thanks a ton. Hey everyone, it's Augustino. If your goal is to build massively successful real estate, you need to understand private equity and have a good, solid growth strategy. Now, optimizing unit economics, making strategic acquisitions, and leveraging the right partnerships are absolutely key to this endeavor. Now, our next guest knows all about this. He is a CEO, a best-selling author, and a speaker with over 20 years of experience growing national service companies backed by private equity. Now, he has served as a CEO of multiple companies that have achieved billion-dollar valuations. He is also the author of two number one Amazon bestsellers on private equity, mergers and acquisitions. He has valuable insights for entrepreneurs looking to scale or exit. If they're working on a deal and they want to exit to private equity, this is the guy that you want to listen to. All right. Now, with all that, I'd like to welcome Adam Coffey to the show. Adam, buddy, thanks for coming on, man.
Hey, glad to be here. Thank you for having me. Hello to all your listeners out there.
Excellent. Yeah, happy to have you on too. But I'm looking forward to this. Now, guys, if you like what Adam has to say, you can reach him via his website at adamcoffey.com. It's spelled COFFEY.com. Okay, we'll put a link in the description. Okay, Adam, go ahead and tell listeners about your journey.
Sure, happy to. So listen, when I meet people for the first time, I generally tell them, here's the handful of things about me. Number one, I'm a veteran, U.S. Army. Military taught the young version of me something about discipline, teamwork, leadership. Number two, engineering background. Engineering made me a meticulous planner, strategic plan always in place. I'm also a pilot. Being a pilot taught me to think about investing with a destination in mind and reverse engineer it. You don't take off as a pilot and just go somewhere. You got to know where you're going to know how much fuel you need and what the weather's going to be in your alternate airports. And so being a pilot taught me think about an end in mind and back, reverse engineer it from there, have a strategic plan in place, military discipline, teamwork, leadership, kind of servant leader type of person. Next, I worked for Jack Welch for 10 years at GE during what I call the Camelot era of GE. Tech doesn't really exist at this point. Steve Jobs is probably still in his garage somewhere, or he's been fired the first time from Apple. And so at that time, GE, world's largest company, number one on the Fortune 500 list. Jack Welch, number one CEO in the world. GE, the world's largest company, is growing so fast, it's doubling in size every 2.8 years. So that taught me about the value of hitting a 30% compound annual growth rate in a business. GE taught me how to run a business. 21 years as a CEO, building 3 different national companies for 9 different private equity firms. I'm a buy and build guy. I bought 58 companies, put them together, billions of dollars in exits. And I got bored. I got tired of just running one company. I wanted to impact multiple companies at a time. I hung up my CEO cleats 2 years ago, told the world, done doing this. I'm now a consultant. I work with private equity. I help them evaluate investments. I help them analyze risk in an investment. I work with their CEOs and portfolio companies and help coach and mentor them and help really take risk out of investments. And then I work with founders and entrepreneurs. I have a real estate cohort as well, people who are building businesses, trying to scale, ultimately probably going to exit in some type of a private equity transaction. And then I teach seminars and books. That's kind of me in a nutshell. That's been my 35 plus year run, in business.
Excellent. No, Jack Welch, for those young people out there who don't know who he is or what he's done, he was known as one of the best CEOs to ever live. I mean, this guy knew how to run a company. He knew how to run a company. So, and you worked directly for him, right?
Yeah, he took the world's largest company and was doubling it in size every 3 years. The stock was splitting every 3 years. He created hundreds of billions in shareholder value. I won't get the numbers right, but I think when he took over, GE as a conglomerate was worth 10, 11 billion and something like that market cap. Went to hundreds of billions of dollars. This guy was the epitome of really modern day business principles that a lot of companies follow today.
Yes, that's right. I mean, I think many companies could probably use some of that discipline these days. I mean, I don't want to turn this into a bashing session, but I think that many of those things, just to your point a second ago, many of the companies today still refer to Jack's, I guess, methodologies, if you will, to running their own company. So phenomenal. So, and obviously you've been able to use that for private equity, to raise private equity, to help people exit into these types of deals. So these days, we talked about this in the green room a bit ago, trying to get your hands on equity to do deals today. Deal is certainly a very different market than it was 18 months ago. Yep. Very, very different. I think these days people have their eye mostly on distressed assets as opposed to regular old, cash flowing type scenarios. What sort of tools, what sort of methodologies do you use today, or what would you use today to try to get your hands on private equity? I know you work with a lot of family offices, you work with a lot of private individuals too. So you have access to these various people. If someone were fairly new to this, how would you recommend that they would do that? And then maybe to talk to the other guy too.
Let's start by just dispelling some myths that there's no money available in the world. So, when I think back over my career, if I go back to the early days as a CEO in a PE-backed adventure, at that time, there were hundreds of firms, not thousands, and there was less than $1 trillion in assets under management. So PE was still kind of in a nascent, kind of a early gestational period. And, today there's over 6,000 private equity firms. There is over 6 trillion in assets under management. I mean, if you took private equity as a force, it would have the third largest GDP on the planet, at this point. And here's the thing. Most private capital or private equity, it's raised from private sources. There's no liquidity, and each fund has about a 10-year lifespan. In charter, it's like I'm going to borrow money. I'm going to take investors' money. Typical minimum investment $5 million. To be an investor. I'm going to grab and pool your money together just like a mutual fund. It's private. It's 10 years. You're not going to see it. And I'm then going to invest that capital. And over that time period, I'm going to pick things to buy and invest in during the first 5 years. I'm going to kind of improve it, grow it in the middle. And then at the end of my fund, I'm going to sell everything I've got. And I'm going to return the capital to my investors. And so right now, today, this very second that we're talking, there's over $1.9 trillion in what's called dry powder. This is committed capital that is not yet invested. And here's a little secret for your listeners. Private equity, the biggest cardinal sin of private equity is if you don't put the money to work of your investors. So I'll give you an example. Let's say I'm a big investor, and I am an investor in several private equity funds. And so I commit $5 million in capital to a PE fund, and they've got 10 years to use it. I don't give them a check for $5 million up front. I have to reserve that capital and hold it and wait for them to give me a capital call. And over the first 4 or 5 years, I'm writing checks, I'm sending wires, I'm getting them the money as they're making investments. If they don't invest my money, I have lost the opportunity to invest it elsewhere. The reason I invest in private equity to begin with is because I'm getting double the S&P 500 typical returns. 30 years in the stock market, I'm going to average 8% a year in capital appreciation. In private equity, I'm looking at 16 to 20%, in appreciation. And so if I hold it from there and I'm reserving it for you, and then you don't put my money to work, I'm pissed off because not only did I not get my 16 from you, I didn't get my 8 from the market. I got nothing. I got money market, fund type interest. And so the cardinal sin of private equity is don't invest money. So there's 1.9 trillion out there. It must be invested. So what I tell investors, or early investors, first of all, invest in what you know, invest in what you understand, invest in what people need. So if I think about real estate investing, people need a place to live, right? Fundamental. Now, I didn't know the government was going to say you weren't going to have to pay rents, for some period of time. That threw us all a curveball, right? But invest in what you know, invest in what people need. People need a place to live. Single family home rentals, multifamily housing, apartment buildings, commercial. Commercial is a type of investment right now that I think is in a quite a reset. There's a lot of interesting things going on in the commercial real estate investment market. That's where I would not want to be the investor if I didn't know and understand this space, but there's a ton of opportunity there. So I would want to invest behind you or somebody else that was an expert in that market if I wanted exposure to it. But I know single family housing, I know multifamily housing. That's my wheelhouse. That's where I'm going to invest. So here's the key. If you're looking for capital, the capital is out there. So how do you get it versus someone else? Here's my secret, my little tip. Be generous to capital. When you are out looking at if you have no capital and you need capital and someone else has got it, how do I get them to give it to me instead of someone else? Well, I treat that capital well. I need capital. I'll give it a higher interest rate than the market. I'll give it a higher interest rate than it potentially is looking for. I've got this great deal. I need to fund it. I don't have the capital. Mr. Investor, Mrs. Investor, I'm not only going to pay you your market rate for interest, I'm going to give you a percentage of what I earn on the property later on when I sell it, in addition to, so I'll come up with some creative way to give a higher return than is typical. And that runs counterintuitive to a lot of people's thinking. I want my money at the cheapest rate possible. Great. If you're established, if you're a well-known, if I'm you, I can walk into a bank or I can walk in someplace and I can get the capital I need. But if I'm starting out, I can't get the capital. And if I can't bootstrap it or do it myself and I need other people's money, I got to give them a higher return than the market would give them, a higher return than they're used to getting to get them to say yes. And that's kind of my key. The money's there. So I'll make a little less on this, early round of things that I'm doing. But that enables me then to create my nest egg, and to get my initial returns and credibility that eventually allow it to be easier for me in later rounds to find money when I need it. Now I've got a track record. Now I've got a history. And I treated you well. I'm going to come back to that. Well, money gets easier as we start to raise it. And the early days, treat the capital well.
I love that example because I've used it before. You have to make them an offer they can't refuse. They feel stupid if they didn't take it. And I think if I'm reading you right, part of it is, I'm going to use air quotes here, giving up some of your upside so the investor is making it, which is cool. But I think another key aspect, though, and you didn't mention this part, so we should talk about this, the length of time is important too, because typically in a multifamily type deal, they may say, it used to be a 5 to 7 year hold or a 7 to 10 year hold, which may be a little long. That's for someone starting out, that may be a little bit long to go without getting paid or getting paid very little.
Right.
It has to be like a killer deal, maybe in the first, say, 1 to 3 years, a 3-year exit or a 4-year exit or something even faster than that, perhaps. I mean, what are your thoughts around that?
Yeah, high IRR, short period of time is important. Remember, IRRs have a time component. And so depending on who I'm looking at, a family office, as an example, probably has a little bit longer horizon than traditional private equity. So a family office might say, I'm more interested in my multiple of invested capital, my cash on cash return. That drives me a little bit more than IRR, because if you give me a good IRR in a short period, I immediately got to put all this money back to work. And so I like putting the money to work for a little bit longer term horizon. So I also have to align where I'm going to get the capital with the type of project I'm doing. And if I'm looking at a family office financing, they probably would like a little bit longer hold period, more cash on cash return. If I'm with traditional private equity, shorter return, higher IRR. Can I tell your listeners why? Let's just analyze this for a second. So the world of private equity, I raise 10-year funds, and I have like 5 or 6 years by charter to put the money to work, and I have to return it in 10 years. I might have a 1 or 2 year extension on the end in case I need it to finish out that fund's life. But I'm going to raise my second fund about 3 years after I raise my first, and I'm going to raise my third fund 3 years after that. And it's about every 3 years I'm raising my next fund. So what do I need to raise my next fund? I need some quick hitters at a high IRR, not so much a cash on cash return, but hey, if you can get me a 3 times multiple of invested capital in 3 years, or a 4 times multiple of invested capital in 3 years, I've got like this 50, 60% IRR. I now 3 years into a fund's life can say my early investment in this fund is a 56% IRR return. I'm now raising this fund. You better hurry up and jump on this bandwagon. And so I also need some of the longer term hold and money because eventually when I'm returning all the capital, someone's going to say, what did that fund return over the life of the fund? But I need some early hits. I need some early wins. And the dogs or the fleas of my portfolio are going to be cashed out at the last second. Why? Because by then I've already raised 2 additional funds and everybody's forgotten about that fund from 3 funds ago. And so we need to understand and have a really good understanding of how private capital works, both in an institutional private equity environment and in a family office type environment. Because if we truly understand that capital, and that's why I wrote that first book, the Private Equity Playbook, was to make sure that people truly understood how this all works, because I look at private equity as a tool. I want to build an empire. I need money. I'm going to use private equity's capital in order to build that empire. In order to get it, I need to understand how it works, what feeds it, what its needs are, so I can give it what it wants, which is returns, and I can take from it what I want, which ultimately is wealth creation for myself, my family, and the people that I work with, vis-a-vis getting the money to build the empire, build the company, build the portfolio. And so understand how that capital works, and then you can really begin to feed and take what you need, and by giving it what it needs, which its returns are. And so again, high IRR early deal, great win. And I need some of those, plus I need some higher, longer term cash on cash returns. Where I get the capital matters, because the horizon and what's important to them is different depending on where I'm getting the capital.
Yeah, and I think and when you say capital, I think people need to understand too, it's equity, and we're talking equity right now, but the debt is important too. And I've talked about this in other shows, is that when it comes to debt, the lender likes certain types of deals. They certain lenders only like multifamily in certain locations. Some of them only like hotels. Some of them only like industrial. And if it's industrial, they give you a better rate or better AM or whatever the case may be. Same thing goes with private money, private equity. If they want the short-term stuff, that you mentioned, the family office looking for a longer cash flow type deal. I think people get discouraged when they're talking to one office and the office says, well, we're looking for X and all you have is Y, and they get all frustrated and they run away. It's like,
Right.
It's important to match up. Hey folks, if you're having a blast, let's take it a notch up. Connect with me on Facebook, Instagram, and YouTube, and all the social media platforms where all the fun is happening. Your feedback is like fuel to us, propelling us to even greater and better content and reach to incredible investors just like you. Thanks for being part of this awesome community, and let's get back to the excitement.
And so again, with thousands of firms, out there, so private equity is the world's largest non-bank lender, right? And so, there are different kinds of funds, different size funds that do different things, and they have different specialties about them. We need to understand, how this world is stitched together so that I'm approaching the right people with the right size and type of investment that's in their wheelhouse in order to have a higher probability of success. And if I'm just starting out, I need to offer it better terms than it's even looking for in order to get them to say yes to my deal instead of somebody else's deal, especially if I don't have a track record. And so, give up some of your returns, treat the money well, understand where the money's coming from and what its needs are. And what you'll find, I think, fairly quickly is there is no shortage of capital out there. There just isn't. The world's filled with money. We just have to know what rocks to look under to find it.
That's right. And speaking of that then, so what sort of steps did you have for raising capital and preparing to work with private equity firms?
So it all starts with a thesis in my mind. So again, I mentioned this already. It's like I focus on needs, not wants. Why do I do that? Because there's this thing in the world called our economy, and it moves in cycles. And if I can insulate myself from a down economy by focusing on needs, not wants, then I'm somewhat isolated, from the impacts of a down economy. And security and cash flow is important. And so, there's a lot of different considerations that we have to make. And so what I typically would tell someone is it starts with a thesis. So I'm starting out, maybe I have no experience, maybe I have limited experience, but this is my thesis on what I'm going to do. I'm going to build a portfolio of single family rental homes, and I'm going to put them in these types of neighborhoods with this type of a rent base, this type of a capital cost, or I'm going to focus on A properties, B properties, C properties. I'm going to be in opportunity zones. I'm going to be in, it's what is the profile of what I'm doing? And I need to write a very detailed thesis in order to demonstrate to the lending community that I understand what I'm about to undertake with your money and your capital. And I really have a story and a focus and a strategy on how I'm going to implement and build, this empire that I'm currently working on. And so we all need these angles. We can't be all things to all people. We better be experts, and so I do tell people too, get focused. Be focused about what types of properties you're going to invest in. Am I a single family rental guy? Am I a multifamily housing guy? Am I commercial, industrial, as we talked about? I can't be scattered all over the map. I need to be very focused. I need to get very good. I talk a lot about unit level economics. I really need to understand the unit level economics for the area where I'm going to be investing. Look, these are the typical capital costs for a house, or for a multifamily housing building. This is the typical price per door. This is the kind of rents that I can generate. And so here's my coverage ratio for the debt, the cash flow, and then here is what the property appreciation looks like in these markets, and this is what I expect over a certain time period to produce with the capital that I'm investing. And so I start with a thesis. We need to really do our research, do our homework, demonstrate that we understand, and then we need to live our strategy. So I'm not just doing this for lenders. I'm doing this because I want to be successful. So I'm a thesis-based, investor that starts with the concept, the idea, do the research, prove out the math. And then I'm really focused on my unit level economics. And as I'm buying the early properties, let's validate the thesis with the actual properties that we purchased. Did we get the cash flows that we think we would? And as I'm adding to that portfolio, and I'm expanding, I'm constantly refining that model. And so what I'm demonstrating is my expertise, right? So the property may secure a note at some level, but really, it's beyond that. The banks, the lenders, the private equity people don't want to be in the business of selling your assets for you. They want to be in the business of you hitting your numbers, giving them their returns, and not putting them in a position to where they have to become you in order to get their capital back. And so we demonstrate the expertise with a thesis. We live that thesis. We track, we refine, we demonstrate track record and history, and we keep going back to the well and keep expanding.
Now, have you ever seen people or companies create a thesis, but to your point, they don't have the track record? Because I heard you say track record in one way, shape, or form. Do you ever see them partner up with someone that has a track record?
Oh, yeah.
And because that might be a great way to somehow bridge that gap that maybe that you as an individual or you as a company don't really have, like say single family. Maybe you're a multifamily guy, you do no single family at all, but you know how to do it. It's a similar formula, but it's still different enough that it's a different profile. Partner up with someone who's done it. And then
I see that all the time. And I would tell you, not just partner up to do it, but potentially, so like you're an expert in your geography in your area, and hundreds of millions of dollars in portfolio, and big empire, right? So if I wanted to understand Cleveland, and maybe I understand Beverly Hills, or Los Angeles, but I don't understand Cleveland. And let me tell you, real estate investing is a street by street, neighborhood by neighborhood, zip code by zip code. It's like, there are nuanced differences everywhere. I can be a generalist and an expert and survive and do well. But I might want to partner up with you because I want to learn a new market, and I want to, not just a new type, but potentially a new market. And I always tell people to specialize in one type of real estate investing so that they become an expert in a given market, in a type of property class. Single family rental, multifamily, commercial, et cetera. And so if I have a reputation in one market, potentially with a universe of lenders, but they've never seen me somewhere else, doing this other type of investing, that might raise, first of all, I probably have some street cred, but they would love to see me partner up, on an early deal with someone that they know, they respect, they understand, has expertise in that market. And now what I'm doing, and here again, just like when I started, I would be overly generous to that partner because what I'm trying to do is establish my expertise by riding their coattails or by learning from them. And the learning is worth more than the returns on that particular deal. And so if I make it a sweet deal, I get to come in alongside an expert. I get to watch, observe, learn, and then I can leverage that learned knowledge. Maybe then the second deal is on my own, or a future deals are on my own. But I love to see partnerships because I honestly believe that each segment of real estate investing has its own unique characteristics, and we really do need to have a developed expertise, or we can get hurt. And from a lender's perspective, that expertise gives comfort that the returns will be there. I'm not going to have to manage this person. To get the first yes, above market deals. Okay, I'll take the risk because I'm getting an above market return. I'm nervous, but I'll give the first deal. Once I've got the deals under, now it's easier for me to get my capital in my area of expertise that I'm developing now. But if I want to wander outside of that, I call it pivoting from strength. And so let me explain that for a second. If my strength is single family home, if I want to go to new geography, if I go from a position of strength, I've been a single family king here, I'm going to go be a single family king there. I'm a multifamily housing king. I only want one hurdle that someone has to believe I can cross. Can I replicate the magic from one market to another? That's the one hurdle. I don't want to go from residential here or multifamily housing here to commercial in a new market. Now I've got two hurdles. I've got commercial, it's a new asset class, and I've got new geography, two hurdles, harder to raise the capital, one hurdle at a time. I'm an expert in one thing, keep doing the one thing in new markets, one hurdle. I'm an expert in one thing, even in the same market, make a pivot. I'm now not an expert in this new thing. That's my one hurdle, but I'm in a geography that I know. Maybe I partner with someone like you in that segment. And so I think about pivoting from strength never more than one hurdle, so that any expertise I've built up, I can go back to a lending base or community and say, here's what I've been doing. Here's my success. Here's my pivot.
Yeah, love it, love it. I've told numerous students of ours in our masterminds the same sort of thing. Like there's these guys, I'm sure you've seen them before. They'll buy 100 units and like they're based out of North Carolina. They're going to buy 100 units in Dallas, 200 units in Austin, 50 units in Cleveland. They're all spread out. They're doing different markets, the markets they don't even understand or know, and they have no business doing it. Focus on one market, get extremely good at it,
and
build
they might
1,000
get lucky
units
too, right? So maybe they succeed, but if the economy goes south, if it cycles, if something happens in a marketplace, they've got no expertise. Those are also the first people to sell the portfolio of 100 homes in a market because it went south on them and they weren't there. They didn't understand it. They weren't experts. We can all ride the wave up when the world is improving. When it peaks and a cycle starts to go down, that separates the people with expertise from those who do not. And it just like any other form of investing, including the stock market, if you invest in what you know, in real estate, carry that further, invest where you know, which is something else I talk about in my books. It's like, it's a neighborhood by neighborhood, zip code by zip code, different types of properties, different expertises, the real estate investing to be successful. Really what you want to do is you're eliminating risk. Anybody can take wild risks in new markets, multiple pivots, multiple hurdles. Maybe I win, maybe I lose, but the lender is the one taking the risk. If I can constantly remove risk, I have a much higher probability of success. This is about wealth creation. This is about winning. I think about someone, so Ty Cobb, best baseball player ever, hit over 400 a few years, but most, I think his career batting average is in the 340s, 350s. If I think about real estate investing or any kind of investing, I got to bat 980 or better. I can't afford to strike out, 6 out of 10 times. I got to have, 980 plus. I can afford one bad deal out of 20, otherwise I'm going to kill myself. And so we really need to be good. So this isn't about how fast can I grow something. It's about how much expertise can I build and knowledge to reduce risk and improve my chances for success.
That's right. That's right. So what common mistakes have you seen other entrepreneurs make on the path to this massive scale it's looking to build?
So if I'm talking business, it's all about unit level economics. And that applies to real estate investors too. It's not having a good command and understanding of basic unit level economics. So let me give you an example for a single family home. I've got a capital cost to buy the property. I've got rents that I can charge. I'm going to have my maintenance costs. It's like, do I truly understand the unit level economics? Can I get enough rent to service the loan, to cover the insurances, the maintenances, the overheads, to produce enough cash flow, for those periods when I don't have renters? It's like, I really have to understand unit level economics. And a lot of times, I can't tell you how many times entrepreneurs have told me, hey, Adam, I'll figure out how to make money when I get bigger. I'm just collecting assets, and if I can survive, time will heal my wounds, and my lack of understanding. And where I find is the difference between success and failure, it happens, call it in our first million, our first 10 million. It really comes down to, do we understand the unit level economics, and are they working for us? Can I generate enough gross profit on the revenue that I can produce from a property to cover the operating expenses, of that property, and to generate enough gross profit to cover my SG&A, my overhead as a business, to attract tenants, to do the accounting, run my books, pay my bills, and do payroll and all those things I have to do, and to leave enough, net profit down at the bottom. I call it the 30-20-10 rule. Can I get at least 30% gross margin, gross profit, at the operating level? So I've got my unit level economics. It could be a product and a product company, a truck and a service business, a 2-person crew. It can be a door in a multifamily housing. It can be a single family house property. Can I generate enough revenue minus my expense to operate that revenue, service that revenue? Can I generate at least 30% gross profit? Can I have less than 20% SG&A? Can I generate at least a dime on a dollar at the bottom? And if I can do this small, I can scale any business to massive size. But if it doesn't work small, people, it's not going to work big. And so if I don't have start with one. What's the one thing we can't buy? Time. I've got limited amount of time. So let's focus on getting it right small. And if we're going to fail or we need to make an adjustment, let's fail small. Let's fail fast. Let's understand what we're doing isn't working before we worry about scaling. People go out there and they just start doing too much too soon. I'm going to buy. I don't even know if it works, but I'm going to buy. Understand what you're doing, make one property work, get it dialed in, understand unit level economics of how it's going to work as an investment. And then I add the second, and then I add the third and the fourth. And I build an actual economic model. If I want to generate $1 million in free cash flow, how many properties do I need to own? So a lot of people, I would tell you, in real estate investing, they really aren't focused on cash flow at all. They're just completely focused on return, and they're collecting assets. I worked with a family office, I told you in the green room, 30 properties in one area. And by the time we deconstructed, when did you buy them? How much did you pay? How much are they worth today? What taxes would you have to pay if you liquidated these assets? No cash flow being generated. They're collecting assets. They're putting nuts in the tree for winter. And when we deconstructed the whole thing, it's like they're generating less than 5%, IRR. I'm like, why do we have all this capital, tied up in 30 properties that produce no cash flow and no hope of a good return after taxes and after selling and paying all our fees? It's like, you're better off to take that money, turn it into cash and put it in a CD, and earn your 4% because you're going to get a higher rate of return. It's like, we need to focus on, why are we doing this? What is the outcome? And too many real estate investors, I'm thinking smaller investors now, collect properties and never sell. They're just collecting. It's like, at some point we need to turn over our assets. We need to redeploy capital. We need to, what's the end game? What are we trying to accomplish? And how are we going to get there? And what's the roadmap to get there? And you better understand the unit level economics or you're going to get hurt.
Yes. Love it. Love it. Listen, Adam, we covered a lot of stuff here today. It's been amazing. And hopefully, I shouldn't even say hopefully, I know that the audience got a lot of value out of this. So what sort of bulletproof advice would you have for someone listening right now on how to take action and what to do next when it comes to trying to scale their business using private equity? Having a blast? Listen, if real estate's your thing, don't miss out. I have plenty of free resources on the bulletproofcashflow.com website, as well as masterminds you can take part in to help elevate your game. Go ahead and check it out.
So crawl, walk, run, focus on needs, not wants, focus on understanding unit level economics, create the thesis, create that economic formula that gets you from 0 to the first million, from the first million to 10. Understand what the end game is in mind. What are we trying to do here? What are we trying to accomplish? Reverse engineer that, put that, into a Gantt chart form timeline. And the biggest thing for individuals or small investors is, who the hell is going to hold you accountable to your plan? If I'm a CEO of a big company owned by private equity, if I'm not hitting my numbers, they're going to fire me. Who's going to fire you? Who's going to fire you if you make bad decisions? It's like, people need to have a sense of urgency around success. And otherwise, we wake up in 20 years and we've stumbled through life. Time is now behind us and we're saying, geez, I didn't get anywhere. I didn't accomplish anything. It's because I didn't have a plan. I didn't have a roadmap. I didn't know what success looked like. And so I didn't know how to navigate to get there. If I tell somebody, get in a car and drive from Los Angeles, and I don't tell them where to go, just go and get in a car and drive. They drive around in circles and then they go back. And that's people in life. But if I told you, get in a car in New York or in LA and drive to New York, now I got a destination. I know I'm going to have to stop multiple times, or I'm going to need a bunch of Red Bull to power me through. And someone's got to feed the cats, the dogs, someone's got to get the mail. I got to water the plants. It's like, I can build a roadmap that takes me from LA to New York. Why are you an investor? What are you trying to accomplish? How do you deconstruct that then and turn it into actionable steps? How are you going to measure success? What are the measuring systems in place? And more importantly, if you're not on your numbers, how are you going to hold yourself accountable? If you can do these things, you'll find much higher level of success in investing.
Nice. Love it. Love it. All right, guys. If you want to reach out to Adam, you can reach him via his website, adamcoffey.com. Think big, but master the fundamentals first. Learning and building a real estate empire requires optimization, economics, strategic acquisitions, and access to ample amounts of capital. And I think Adam's put out a lot of great materials, so you definitely check it out. He can show you how to do that. So that's it, guys. Thanks for tuning in, and I'll see you in the next episode.
Thanks, everybody.
Take care.